Investors are pushing back against the Federal Reserve's higher for longer rate message as we go into the last month of the year. And while they're out, they are watching out for Fed Chair Jay Powell's comments today and looking to the December meeting. Debate over achieving a soft landing persists. Our next guest thinks that the risks to our soft landing baseline look balanced. Let's bring in S&P Global Ratings Global Chief Economist Paul Gruenwald joining us on this Friday. Paul, good to talk to you today. So if things look balanced, what does that ultimately mean? Is the Fed going to stick the soft landing?
Yeah, well, thanks for having me on the show. We think that's the most likely scenario right now. We've continued to underestimate the strength of the labor market in the U.S., and that's really the secret sauce. As long as services spending remains robust and as long as the labor market, which is driven by that, remains robust, we think that the Fed can slow the economy as a result of their rate hikes and, get down to a more sustainable path. We're going to have to grow below potential, kind of 1.5-ish for a year or so to take out the excesses. But for us right now, that's the most likely scenario.
There is a bit of messaging happening, obviously, from the Fed chair today, trying, as he sees the market kind of run ahead, not just on the expectation that the rate hiking cycle is done, but that there could be cuts going into next year. I mean, how do you see some of the messaging coming through today as the Fed tries to keep optionality available?
Right. That's a bit of a balance because the Fed controls the short-term policy rate, but they want the markets to do the actual work through the financial conditions. So when the Fed or any central bank starts to tighten, that has an effect on yields and spreads and asset prices and everything else. If the market starts to ease too early and we see bond yields fall, for example, that eases financial conditions too early and kind of increases the probability that the central bank has to do more. So I think the Fed would prefer not to do more at this point and let the markets do the work. But the job of the markets now is to kind of keep those financial conditions tight enough to slow the economy. And if we're continuing to see drops in bond yields, that's kind of going in the wrong direction.
Yeah, I was going to say that. I mean, if you think about easing, we have seen those bond yields pull back pretty rapidly, at least in the month of November. Is that a concern for the Fed, or are we still kind of at this rate where they feel comfortable with where the market is headed, at least on the yield side of things?
Yeah, we think the December meeting's kind of not a toss-up, but there's still a chance the Fed may have to tighten more. But again, if the financial conditions in the market aren't restrictive enough to slow the economy in the judgment of the Fed, they'll have to do more. And by the way, this is not just a Fed issue. We've heard the same from senior folks at the European Central Bank as well. So again, the central banks control that short-term instrument, but they need the markets to generate those tight conditions. And if the markets kind of get ahead of the game, as you said, and try to ease things too early, that just makes the central bank's job harder and kind of raises the likelihood that they may have to tighten a little bit more.
You mentioned the expectation going into next year. Sure, there could be a soft landing, but we're looking at sub 2% growth here. What's the one thing that you're watching right now that you think could derail that narrative?
Yeah, as I said earlier, it's really the labor market. The labor market's been a pleasant surprise in the U.S. and elsewhere. The other thing that really surprised in the U.S. labor market last quarter was labor productivity kind of jumped. So unit labor cost, the cost of workers actually fell, which is quite a positive sign for the market. So our view is as long as the labor market strength holds up, this will allow us to decelerate the economy at a measured pace. But if the labor market really starts to go south, and we'll see that in the payroll numbers, if that happens, that means the economy is probably going into a harder landing or a recession, and the Fed would be cutting earlier. But again, that's not our baseline right now, but that's the one key variable to watch in our view.